just got done showing a property. It's got some time to address a common question that I've been getting recently from a lot of my clients. They're looking to buy a home in today's market is how much can I borrow based on my incomes? Obviously, this is a question that you could always ask a local mortgage professionals. But I understand that some of the people that are at the very beginning of their home buying process, that they're probably not ready to have that conversations yet. And of course, before you go to a loan officer, there's always something that you could do to self-assess your own borrowing power, which I'm going to show you just in a second. And of course, what I'm showing you is something that I would do at the very beginning to self-assess. It's not going to be an accurate estimate of how much I could borrow and what type of interest rate that I can get. Those will be something that you'll definitely need to check with a local mortgage professionals. But what I'm going to show you is something that you could do on your own just to give you a ballpark estimate, a general understanding of what you could borrow and what price point you could probably be looking at. So, without wasting any more time, let's get into it.
Okay, here we go. Now, before you talk to a loan officer, if you want to self-assess your own borrowing and purchase power, this is what I would do. Okay, so first, let's take a look at the current interest rate as of 2020, September 10th, which is today I'm recording. And this is Bankrate's website. And let's just take the 3-year fix, which is given us 3%, as a reference. Again, the actual rate that you'll be qualified for is going to be either higher or lower than this number. But for the purpose of this demo, I'll just take 3% as today's interest rate. And let's go to a calculator. So let's say, as an example, you're making 5,000 a month, which is 60,000 a year as your salary, and you are a regular W-2 employees who have been filing taxes for more than 2 years, and you're not a VA, you're just a regular home buyer, and $5,000 a month, and you have, say, $500 a month personal debt. It could be your student loan, your car payments and stuff. So your debt is $500. So now, if your loan amount is less than 765,000, I believe as of today in the state of California, you're less than the jumbo. And in this case, what the bank requires is a 50% DTR ratio, which means your total debt, including the mortgage, should not be exceeding 50% of your monthly income. In this case, if you're making 5,000 a month, then your total monthly debt should not be more than $2,500. So let's take $2,500 and from subtract that from 500, then your monthly mortgage payment should not exceed $2,000. And going back to the mortgage calculator, so let's say California and interest rate to be 3% as an example. And don't worry about credit scores and all that. And let's just type, let's say $450,000, let's say. So that would be okay. I think you can go up to maybe $480,000. That would give you right around $2,000 monthly mortgage payment. And now, when you're buying a home, you have a down payment, which is going to be the amount of cash that you want to pay towards the purchase of this home. So let's say you have about $50,000 cash that you want to spend towards your purchase. Then we'll come back here and take $480,000 plus $50,000. That would be $530,000. But because you're buying a home, and in pretty much most counties, there will be a closing cost that the buyer will have to account for. And typically, let's just set aside $10,000 for the closing costs. So this makes your purchase power no more than $520,000 based on this set scenario. And one thing buyers should take into consideration is that if you're looking for a home right around $520,000 and you only have $50,000 cash towards your purchase, then you're making a less than 20% down payment. And if that's the case, for anything that's less than 20% down payment, your interest rate is number one, likely to go up. And then number two, the lender is going to require you to pay a mortgage insurance. So that could be 100 or 200 a month, depends. So if that's the case, I would say if you're gonna make less than 20% down payment, then I would say instead of 480, I would say probably like 430 to be on a on the safe side. So in that case, that's 50% less than 520. So let's just subtract that $50,000 from it. So if that's the case, then your purchase power is $470,000, which means, when you're shopping for homes, 400, like the high 400s, is going to be more than likely going to be your affordability. And of course, everything that I just show you is what you could do to self-assess your own financial situation for your own purchase. And of course, if you want to know more about how, what exactly the interest rate that you can qualify for and the down payment options, and are there any other options, how many, like 30-day close or 25-day close, or do you need a loan contingencies and all that, I highly recommend you to sit down with a local loan officer that can go over your files and your situation. They will be able to give you the best options for you when it comes to purchasing a home. What I'm showing you is just before you go to them, if you want to do a self assessment, this is how you do it. Hope this helps.